Hello and welcome to the Smart Money, Dumb Money show. And my name is Keith Richards. I'm the president and chief portfolio manager of Viatron Wealth Management. And today we're going to talk about why I feel that September, which is often from a seasonal point of view, a relatively volatile month compared to many other months during the calendar year. I'm going to talk about why I think this September, in particular, the second half of the month, we're recording this on the 14th of September, why I feel this next 2 to 3 week period may bring with it some extra volatility that we haven't actually seen for a while. And I'm going to refer to some research done by a great company called sentimenttrader.com, and they're producing a chart that shows us the relationship of the VIX to actual volatility and how that's deviated of late. So let's get right to it. And I'm going to share the screen and go to the Sentiment Trader chart. So this is a chart courtesy of sentimenttrader.com. And what we can see is at the top, the level of realized volatility, actual volatility. Now it's smooth, it's a 50-day average and against a 50-day average. So you can see if the line is high, that means that realized actual volatility is higher on a relative basis from its average over the past 50 days. So this is a zero line, meaning that it was pretty much in line with the average. So what we're going to look at here is that the relationship between the actual VIX, the VIX, which is a measurement of option premiums. So VIX, standing for volatility index, shows us what writers of calls and puts demand in premium for the options that they are creating and writing that other investors can buy off of them. These writers of calls and puts want a higher premium if they suspect that volatility is going to pick up. Of course they do. If prices might go up or down more than anticipated, they want a bigger premium because they don't want to be called or put on their options. So the VIX tells us the amount of fear. It's sometimes called the fear index because usually it tends to move more aggressively on the put side of the world when people are, or I should say the options writers are becoming more fearful. So here we have the VIX, the blue line, and that too is a percentage of the 50-day range. And here's the actual volatility. And you can see the two work together. Of course, when volatility goes up, so we get bigger price swings than has been the norm over the past 50 days, then the writers of options get paranoid and they demand a bigger premium because they suspect there's more to come when it comes to volatility. And when the actual volatility slows down, you can see the premiums start to shrink. On and on. So the VIX goes up when volatility goes up, the VIX goes down when volatility goes down. And it's because the option writers are simply reacting to what's going on. All right. So very clear relationship. You can look at this over and over in this chart. When you see a downward swing in volatility, you see the VIX fall as well. So here's something interesting. This is what Sentiment Trader is pointing out. And I might also mention that Larry McDonald of Bear Traps pointed out this exact same phenomenon, and that is that VIX premiums, so option premiums, the VIX level is very high right now compared to its 50-day average, and yet the actual volatility is very low. Now, this is not the normal occurrence. So what the options writers are saying is that I know volatility is low now, but we see it coming very soon. Larry McDonald of Bear Traps actually pointed out that this is the highest options premiums he's ever seen in a low volatility environment. Very interesting. So if we assume that options writers are a little bit more investment savvy than ordinary stock investors, then perhaps they're seeing something that we don't. Now, that's an assumption, and it's hard to say, but historically, and I'm going to now go to a different chart, and to do that, I will zip over to this. So this is a chart of the S&P 500, and perhaps I don't blame the option writers for becoming a little bit more paranoid and a little bit more demanding of the premiums that they charge on the options that they write. And the reason for that is because we have been, since roughly April or May, in a period of very, very low volatility. So look at, this is the S&P 500, and here's May on the chart. And you can see that it's been pretty tight. My band lines here are pretty tight. This is a measuring tool that Stock Charts offers. It's the percentage. You just measure the percentage of the drawdown or the move up. And as you can see, the drawdown from the biggest swing that we've had so far since May has been negative 3.7%. That's very, very small. Okay. If we compare that even to the period coming out of the COVID crash, which was basically March of 2020, even though the market went up aggressively. So this was not during a volatile period. The COVID period was volatile, but the market actually rose quite strongly, as we all probably know, between May of last year and well into the end of this year. But still, it had normal swings, normal price swings. There was an 8% drawdown in June. There was about a 10% drawdown in the fall, September. Imagine that. There was another 8%er in the later part of the year and coming into November. And then a 5.8% is what that number says, almost 6 in March of this year. So this is kind of normal volatility where you get these 5 to 10% swings in an up market, because things aren't always perfect. People always have something to worry about. Investors move from one sector to another, et cetera. And it causes volatility. Well, that volatility hasn't been happening lately. You probably saw my blog recently how this exact same situation happened in 2017, where you had very tight volatility. In fact, that year, there was not one correction that was above 3%. At least this period, we've seen 3.7, which is not far off of the 3% ceiling of volatility that we saw in 2017. Whatever the case, the options writers are telling us that they feel worried about volatility, and they're worried now. Now, this information is very current. So if you watch this video a month from now, the story could be done. I'm posting this video as soon as I can, just so you get the information on the volatility. And I hope very much that you receive some good information here. There's no guarantees that there will be volatility, but history does tend to rhyme, as they say, if not repeat itself. So my bet is that we may see some sort of a correction, just to bring us back to a normal trading environment. And that's really all I'm imagining, not a big bear market, but one of these normal 5 to 10% corrections is very much overdue. Can we call the time? I can't, but the option premium writers seem to be calling it right now. Should we listen to them? I don't know, but I would just say that I know that this condition of low volatility won't last forever, so I might just give them an ear. Thanks for watching. Have a great day.